The image of a new vehicle slipping beneath the surface captures a growing reality for millions of drivers. While the car remains physically present, the financial structure supporting it has grown increasingly heavy. Many buyers find their debt obligations outweighing the physical value of the vehicle almost immediately, creating a state of persistent negative equity that persists for years. On the surface, the process appears completely standard. Dealerships operate with the same familiar atmosphere of routine commerce and consumer choice. Buyers walk the pavement, inspect window stickers, and calculate their budgets based on what they assume are the standard rules of a car purchase. This chart shows how dramatically those budgets have shifted. Historically, an average car payment stayed within a manageable range of $300 to $400. Current data shows the average payment for a new vehicle has climbed to $745, with used vehicles reaching $521. The most significant growth is in the highest tier, where a record number of consumers now commit to monthly payments exceeding $1,000. The immediate explanation often focuses on macroeconomic shifts. When payments rise, consumers naturally look towards central banking policy, assuming that higher federal interest rates are the primary driver of these increasing costs. While Federal Reserve rate hikes increase the baseline cost of borrowing, the math suggests other factors are at play. A 3 or 4% increase in the federal funds rate is insufficient to explain why average monthly payments have nearly doubled, or why $1,000 obligations are becoming common. Inflation and rising rates provide only a partial explanation. To see what is actually driving these record-high payments, we have to examine the specific mechanics within the loan contracts themselves. The current crisis is built on 3 distinct pillars that restructure how automotive debt is calculated and maintained. The first mechanism involves a significant expansion of the loan duration. A generation ago, the standard auto loan lasted between 36 and 48 months. Today, the industry standard has moved towards 72 and 84-month terms, creating a 7-year commitment for a rapidly depreciating asset. These side-by-side timelines illustrate the impact of that duration. The 48-month schedule on the left shows the principal balance dropping as the borrower builds equity. On the right, the 84-month schedule shows how slowly the principal decreases. In these longer terms, early payments go primarily toward interest, leaving the actual debt balance high for the majority of the term. This creates a conflict with the physical reality of the vehicle. Cars lose roughly 20% of their market value immediately upon purchase and continue to depreciate aggressively over the first few years. This downward curve tracks that loss of value against the 84-month loan balance. The gap between the loan balance and the vehicle's market value represents negative equity. On a 7-year loan, most buyers spend years 2 through 6 underwater, meaning they owe thousands of dollars more to the bank than the car is worth on the open market. This becomes a trap during a trade-in. If a buyer needs a different vehicle before the 7-year term ends, the dealership often takes that thousands of dollars in negative equity and rolls it into the next loan. The buyer begins their next purchase already carrying debt from a vehicle they no longer own. All loan terms provide the illusion of monthly affordability, while ensuring the principal balance remains high enough to prevent the consumer from ever achieving true ownership of the asset. The second mechanism is applied during the negotiation phase. After a buyer selects a car, the dealership submits their credit profile to lenders to secure an interest rate. This part of the process is often presented as a helpful service to find the best possible deal for the buyer. This flow diagram reveals a hidden discrepancy in that negotiation. Based on the buyer's credit, a bank may approve a buy rate of 6%. However, the dealership may present the buyer with a contract rate of 8 or 9%. The difference between these two rates is the dealer reserve. It is a specific profit margin added to the consumer's borrowing cost by the dealership. The buyer signs the contract assuming the rate is based solely on their creditworthiness, unaware that the dealership has quietly increased the interest for its own profit. This practice triggered massive investigations by federal watchdogs. The Consumer Financial Protection Bureau examined how these interest rate markups were applied and whether they were being used to unfairly increase the debt burden on unsuspecting consumers. Federal regulators eventually secured multi-million-dollar settlements from major automotive lenders. Ally Financial paid $80 million, and Honda Finance paid $24 million to resolve allegations surrounding these markup practices. These cases confirmed that dealerships were systemically inflating borrowing costs at the point of sale. By the time a buyer finishes the negotiation, the dealership has often already secured an artificially high interest rate, locking the consumer into a more expensive debt schedule than their credit score required. The final phase occurs in the finance and insurance office. This is where the final paperwork is signed and where the dealership attempts to maximize the profit on the transaction through the sale of additional products. Buyers are presented with a variety of aftermarket items, such as extended warranties, gap insurance, and various protection plans. These products often carry retail markups as high as 200 or 300% over the actual cost the dealership pays to provide them. This diagram shows the financial impact of these additions. These products are usually rolled directly into the financed principal of the loan. As warranties and fees are added to the base price of the car, the total amount borrowed increases, often by thousands of dollars, before the loan even begins. Because these costs are part of the principal, the buyer pays compounding interest on them for the next 7 years. A $3,000 warranty eventually costs much more as interest accumulates, significantly increasing the total financial obligation of the buyer over the life of the loan. While these items are sold as protection for the consumer, they serve as debt multipliers that significantly increase the starting balance and the total interest paid. These three mechanisms work in tandem to maximize the debt burden. When executed together, they create a financial structure that is extremely difficult to escape. It begins with the 84-month timeline, which ensures a slow paydown of the debt while the vehicle's value drops. The dealer reserve markup is then applied, increasing the interest rate and making the loan balance stay higher for even longer. Finally, the F&I products are rolled into the principal, causing the starting balance to jump. This combination expands the underwater zone until it covers almost the entire duration of the loan, keeping the borrower in a state of persistent negative equity. The intersection of these three factors, extended terms, hidden markups, and inflated principal, explains why auto loan balances and delinquencies are reaching record levels across the economy. While the system is complex, it is also predictable. By understanding these specific mechanics, a buyer can take steps to avoid the trap entirely. Obtaining pre-approved financing from an independent bank or credit union before visiting the dealership is the most effective strategy. This allows the buyer to bypass the dealership's lending network and eliminates the possibility of a hidden dealer reserve markup. Buyers should negotiate the final price of the vehicle rather than the monthly payment. Additionally, researching gap insurance and warranties independently often reveals much lower prices from third-party providers, allowing the buyer to avoid rolling high-interest add-ons into their loan principal. The record high payments seen today are the direct result of these overlapping financial mechanisms. By identifying the architecture of the deal and preparing in advance, consumers can remove these hidden costs and return the transaction to a simple, sustainable vehicle purchase.